LMCG is a multi-boutique investment firm. We were founded in 2001 and we're based in Boston. We attract high-quality investment talent, and then we surround them with an institutional caliber infrastructure in compliance, operations, and trading. And our clients run the gamut from high net worth individuals to some of the largest institutional clients around the globe. For our clients, we provide unique expertise in the most inefficient areas of the marketplace today. We've done that by attracting some of the best talent in the business and providing them with a very entrepreneurial culture that allows them to focus on their jobs on a day-to-day basis. Our investment team is led by Gordon Johnson and Shannon Erickson. They have worked together for over 10 years and manage investment strategies in both the U.S. equity market and the international equity markets.
Yeah, so the Global Market Neutral Fund is a long-short fund which is intended to not really move up and down with the stock market or the bond market or really pretty much anything else, and it achieves this by going long attractive stocks in our quantitative stock selection model and shorting stocks which score poorly. And the goal is to add returns primarily from stock selection, not bets for countries or sectors or industries or anything else. It's pure stock selection. Yeah, we launched the fund, the mutual fund, in May of 2013. The strategy actually goes back considerably further and was launched in early 2007. So we launched the mutual fund because we were very happy with the characteristics that we were seeing from the strategy, where it was uncorrelated, generated fairly consistent, low volatility value added, and we wanted to launch the mutual fund so that we could make this strategy available to a broader audience through a registered mutual fund vehicle. The goal of the portfolio is to provide capital appreciation that's uncorrelated with most financial assets, uncorrelated with stocks, uncorrelated with bonds, but also capital preservation so that in a down market we hang on to capital that investors have entrusted us with. That's the long-run goal of the portfolio: capital appreciation and downside protection. Our investable universe is really two pieces. It's the domestic stocks, which you can think of as primarily mid-cap and small-cap US. And the reason for that is we find that our stock selection models work better as we go down into smaller cap stocks. On the non-US side, it's more large cap in nature, and the reason for that is we find that the ability to short stocks really dries up or goes away as you go down even into mid-cap stocks. So we've really got two investable universes, and we have about 2,000 securities in each of those, which are our prime investable universe, so it's really 4,000 stocks in total.
I think one of the main things about our process is that we really strive to be as market neutral as possible. So we've built a lot of portfolio construction tools to help us do that. We want to have a portfolio that's balanced across our three different stock selection metrics: value, quality, and market dynamics. So we're looking to go long stocks that are attractive on those metrics and short those that are not attractive, but at the same time managing our risk. So the risk factors are things like beta, market cap, country, sector. Our tools will show us interactively, so as we build the portfolio, when you put in a trade, you can see all those exposures in a report to make sure that you're balancing out those factors and making sure that they're as neutral as possible.
So our process is quantitative in nature, which means that what we're really doing is using quantitative stock selection models to rank stocks highest to lowest and figure out which ones are most attractive and which are least attractive. We divide our quantitative stock selection model into three main categories. The first is market dynamics. These are things like price momentum or analyst revision. They tend to be shorter term in nature, and we actually think of them as more of a catalyst. The second is valuation. This is looking at how cheap or expensive a stock is relative to its peers. And the third is quality, earnings quality. And what we're really looking at is measures of whether or not the firm's success is likely to continue in the future, how repeatable are their sources of success. So market dynamics factors are really two main categories. The first is price momentum, which is how the stock is performing in the stock market versus its peers. Is it going up more? Is it going down more? How is it performing in the stock market? The second is analyst revision. Our Wall Street analysts revising their forecasts up or down, more or less, relative to the stock's peers. These tend to be somewhat shorter term in nature, and we really think of them as catalysts for the stock in the near term. You know, how likely is that to be a catalyst that the stock is going to take off, either in an upward direction or a downward direction. So value factors are measures of how expensive or cheap a stock is. So we compare them to their peers. And so these are things like price to book, price to earnings, metrics of how expensive or cheap the stock is, and these tend to be more intermediate term in nature. And what we're really looking for here is reversion to the mean. When a stock gets beaten down and gets cheap, ultimately they tend to get their act in order, and some portion of them will turn around and go back up. Conversely, when a stock is doing really, really well, the stock can get bid up too high, and that's where really high valuations come from. So quality factors, what we're really looking at here are the sources of a company's success. So we're looking at the quality of their balance sheets, the quality of their income statements, and we're looking at things like profitability, capital usage, efficiency ratios, accruals. We're really looking to see how repeatable a company's success is, and is it likely to continue in the future. Now, the three categories of factors that we use in our stock selection or alpha model are market dynamics, value, and quality. So the way we combine the factors in our stock selection model, market dynamics, value, and quality, is roughly equally weighted, which means that each one gets the same emphasis in the model. So the investment process is really straightforward, and what we mean by that is we're going long attractive stocks, we're going short unattractive stocks. At the end of the day, that's what we're doing, but it's done in a very disciplined, risk-controlled, hands-on manner. So we designed the strategy to exploit as many alpha sources as possible so that the strategy could outperform more consistently. The three sources of alpha diversification are investing globally, investing long and short, and including multiple factors in our stock selection model. So investing globally is one of the keys to alpha diversification. We invest in the US and we also invest internationally, and we run the portfolio as two sleeves. Now, one interesting observation is the correlation between major market indices. So for example, the Russell 2000 and EFA, they have fairly high correlations with each other. But what we have found is that our stock selection model and our stock selection factors have much lower correlation. So for example, when price momentum is paying off or working in the US, it may be working differently internationally. And what this results in is alpha diversification. So another way we diversify our alpha sources is by investing long and short. And what this means is that we've got two opportunities to earn alpha. So we don't just use the shorts to offset our longs for risk control, but we also seek to add value added in the shorts just as we do in the longs. And what we also find is that our longs and shorts, the alpha factor payoffs, are not exactly the same through time. They don't pay off the same, just as they don't pay off the same in geographies or sectors. So what this also does is we've got two ways to add value, but we're also diversifying our alpha sources between the longs and the shorts.
We don't invest in ETFs because you're not able to add value through stock selection by investing in an ETF. You're really buying or shorting a basket of stocks or an index, so you're not adding value from stock selection. Our goal is to buy or short individual securities within the local markets so that we can add value on the long and the short side through stock selection.
Yeah, the final way that we diversify our alpha sources is also important to the strategy's success, and this is by using multiple sources of alpha. So for example, we believe that we can improve our odds of outperforming in a variety of different market environments if we include elements of both growth and value in our investment process. So the result is a core portfolio which is designed to outperform in a variety of market environments regardless of which style is in favor. In a nutshell, I'd say that this strategy is actually fairly straightforward. We invest in stocks on the long side which we believe have a likelihood of outperforming. We invest in stocks on the short side which we believe are likely to underperform, and we do this by diversifying our sources of alpha. We invest globally, and we also invest long and short, and we do all of this in a risk-controlled manner.
Our strategy is to provide positive returns regardless of the market environment. Obviously, we can't do that if we're highly correlated to that market. Value and growth tend not to be correlated, so with value, we're trying to assess a company's cheapness or expensiveness versus its peers. So we're looking at things like price to earnings, price to book, to get a sense of the valuation of the stock. With the growth elements, it's more about a catalyst for the stock, like Wall Street analyst revision or price momentum, and these are more short-term in nature. So just the way that the factors work are different, and they're pretty lowly correlated. So if you have both of them in your portfolio, hopefully if one style is working and the other one's not, they can offset each other and help you outperform more consistently. A market neutral strategy means that you can go long and short, so different from our long only strategies where we only have opportunity for stock selection on the long side. This time we can go long and short. So we're not only getting stock selection on the long side, but also on the short side, and we're also able through the shorts to hedge out market risks, so what you're left with is pure stock selection or alpha. This process should provide a return series that has low correlation to stock and bond indexes, but that doesn't mean that it's always going to go up when markets are down or down when markets are up. That would be negative correlation. What we're after is non-correlation. But in periods of stress where other asset classes have shown that their correlation goes up during that time, our process has continued to add portfolio diversification. One of the things that's most important is that we run the strategy as a global strategy, which helps because how our process works and how stock markets move is not universal. So there might be times where a factor is working particularly well in the US, but it's not working at all internationally, or vice versa. So this low correlation with the factors means that there's going to be times when it's the US stocks that are adding most to performance, and other times where it's the international stocks, or maybe both sleeves are working well, but not by the same magnitude, or they're both not working well, but by different magnitudes.
So what we mean by market neutral is being neutral to the market, so our longs roughly offset our shorts. If we're $10 million long, we're approximately $10 million short. But we also are neutral to other risk factors such as beta, country, sectors, and industries. So the key to downside protection is neutralizing these other factors. It's possible to have a long-short portfolio that's neutral on a dollar basis to the market, but not neutral to the risk factors, and these may not result in a portfolio which has downside protection. For example, you could have a dollar-neutral portfolio that was invested long in higher beta stocks and invested short in lower beta stocks, and this will result in a portfolio which has a positive bias towards beta and will not be neutral to the market when the market goes up or down. Similarly, the portfolio may be long or short, more or less, in different industries or countries, and will also be taking on market risk associated with that. So in our portfolio, we strive to be neutral, or as neutral as possible, to all of these while still being dollar neutral at the overall portfolio level. So for example, in technology, we're going to strive to be equally exposed on the long and the short side, and have an equal dollar amount of longs in technology and an equal dollar amount of shorts in technology, so that we have roughly no net exposure to technology stocks. Countries are a little bit more difficult to be neutral to. The reason for this is many of our industries cut across countries, and so it's harder to remain exactly neutral at the country level. Still, we recognize this risk and we strive to be as neutral as possible to individual countries. So we divide risk into two buckets. The first is risk related to our alpha factors, which is risk that we actually want to take on because these are things that pay off on average over the long run. The second risk bucket are risk factors. These are risk factors that we don't want to take on exposure to, such as country, industry, beta, and so on. And those are things that we want to be neutral to, or as neutral as we possibly can. So what we're really trying to do with the strategy is be positively exposed to our alpha factors and neutral, or as neutral as possible, to the risk factors. Risk from alpha factors is risk that we're willing to take on because this is our source of value added. We've found that in the past, these are factors which have paid off positively on average in the long run. Of course, there's no guarantee that they'll continue to do so or that they'll always pay off positive in up markets or in down markets. The goal of the portfolio is to have diversified sources of alpha and have exposure to market dynamics, value, and quality so that it can outperform on average in a variety of different market environments. That doesn't mean that it will outperform in every market environment. Since the inception of the strategy, the alpha that we've delivered has had fairly low correlation with both equity markets and fixed income markets, which we think provides added diversification that's needed in many investment programs. What a long-only portfolio manager does is invest in stocks that they believe are attractive and are likely to go up. What the long-only portfolio manager does not do is take advantage of stocks that they don't like, that they believe are going to go down. What we should expect from a long-short manager is exposure to their investment style on both the long side and the short side. For example, if a manager was just a value manager, you should expect them to have twice as much exposure to value because they're going long the cheap stocks and they're shorting the expensive. What we do is we go beyond that to get a core approach. We augment value by also having market dynamics and also by having quality. So we're going long the most attractive market dynamic stocks and we're going short the least attractive market dynamic stocks. The same thing on value, we're going long the cheap stocks, short the expensive stocks, and on quality, we're going long the high quality stocks and we're shorting the stocks that have really bad or poor earnings quality. And all three of those combine to give us a more core, diversified portfolio where we've doubled up on our alpha sources, but we've got more than just one of them. We've got a diversified source of alpha. We construct the portfolio with proprietary tools that we've built to help ensure that the portfolio has the risk and alpha factor exposures that we want on both the long and the short side of the portfolio. Risk factors are things that we want to neutralize, so we want to know that the long side exposure is offsetting or neutralizing or canceling out the short side exposure. In terms of the alpha factors, these are things that we want to have exposure to, and what we would like to do is to have similar exposure on the long and the short side so that we magnify or double up. This is what we mean when we're talking about double alpha. We want to get that double alpha across both sides of the portfolio. And the tools allow us to also do this to make sure that we're neutralizing the risk factors and getting double exposure to the alpha factors across industries, across sectors, and across countries, as well as at the overall portfolio level. So in short, what makes this portfolio special are really three things. Its global nature, which means it invests in the US but also outside the US, the fact that we are attempting to generate alpha from stock selection only, and that it's got diversified sources of alpha. It's not just one factor category, but three: market dynamics, value, and quality. And all of these result in diversified source of value added, which should make it appropriate for many investors.
Many advisors have traditionally managed and customized portfolios with two tools, stocks and bonds. While there are many variations to stocks and bonds, the core portfolio is built on roughly the exposure of equities for growth and fixed income for income and stability. Well, in the world of liquid alternatives, that's changing. We call this a core satellite approach, where alternatives are looked at and evaluated on their ability to not only add value to the portfolio over time, but also to stabilize the volatility so that during periods of stress, the portfolio is less likely to decline along with the stock and bond market.
We do that by creating a strategy that is designed to be neutral to changes in interest rate moves and beta, but also attempts to add value to the portfolio through stock selection, both on the long and short side.
That way, the investment advisor can create and customize something very different than they've been able to in the past, and therefore achieve perhaps the best long-term return for the risk they take for their client. This is a liquid alternative. It's probably one of the more conservative liquid alternatives in that it's not using leverage in any sense to gain volatility. So we think it's probably a great first liquid alternative to put in the portfolio, and we would believe that it would be surrounded by other kinds of strategies that perhaps take directional bets in markets, perhaps they're in very different markets altogether. All told, being uncorrelated,
but also something that seeks to add positive returns over time. We think it would be a healthy addition to a portfolio from a return and risk standpoint.
So we find that it's going to be a great tool, I think, for structuring and customizing a risk profile for an investor who is just not tolerant of pure stocks and bonds and the combinations of those two during particularly bear market cycles. And we're worried in particular in the future about the potential for a bad bond market that would go along with a bad equity market. And so this strategy is designed to sort of hold up fairly well during periods like that and to provide a third leg of a stool for that kind of, for the stability of the portfolio. We think longer term it's a permanent part of the exposure that might be adjusted up and down, and it also will work well in combination of different kinds of liquid alternative strategies as you build out and customize individual investor portfolios.